I've got an exit interview with the outgoing head of the super fund. Matt Whineray reveals why its investment mix may have to change and what he thinks about that $10 billion tax bill.
I don't think it makes sense. We're not here to give up returns for sustainability outcomes, but we're looking to find those opportunities which can do both.
It's Monday the 11th of September and you're watching Markets with Madison. New Zealand's Superannuation Fund has managed to make an average annual return of almost 10% over its two-decade lifetime. Its overweight on international growth assets has clearly paid off, but its deadline for withdrawals is coming up quick. They're due to start in 2030, which may force a change in its long-term mindset. The super fund was set up by the Labour government in 2001 with the intent of generating returns to eventually cover some of the cost of pension payments made to New Zealanders when they hit 65. It's predicted that by 2050, 1 in 4 New Zealanders will be of retirement age, causing a large drain on the Crown's books. The super fund's role is to plug some of that hole. It started making investments in 2003 with its first government contribution of $2.3 billion. Today, the Crown has contributed $24.7 billion and the fund is worth $62.9 billion. That's thanks to its average annual return on assets of 9.59%, well above its benchmark of Treasury bills. Its portfolio mix is weighted to global growth stocks, speaking to its longer-term investment mandate. It's also involved in private equity and venture capital. It started taking a serious interest in infrastructure in 2017 and in 2019 put in a bid for Auckland's light rail project alongside a Canadian pension fund. But the bid failed in 2020. The super fund has now got its sights on building an offshore wind farm off the coast of Taranaki to power more than 600,000 homes. It's created a joint venture with the Copenhagen Fund. It's a fitting move for the fund, given its focus on climate investment. In 2021, it adopted a sustainable finance approach. But how does that actually determine its investment decisions? And are they due a change anyway as withdrawals close in? I sat down with its outgoing Chief Executive, Matt Whineray, at the Responsible Investment Association conference to find out. Matt, thank you so much for your time. Good to see you.
Thanks, Madison. Great to see you.
There's many problems in the world, and you alluded to many of them in your speech. Why has the super fund picked climate change as the big problem for it to solve? Is that because you worry about it most, or is that because it's the one that you actually feel like you can make a difference in?
Well, there's a bit of both in that, actually. So climate change, from an investment perspective, affects everything. It affects every sector, every geography. It's all the way through the system. So for us, it was a natural thing to think about from an investment risk perspective. So what I talked about in the speech was for us it started as a way of saying there's a risk in the portfolio that we're not being paid for. We don't think markets do a particularly good job of pricing climate risk. And as a result, we need to do something about that. So that's why it's that. What's happened since then, there's become a lot more understanding of the other systemic risks. And you mentioned them, there's other things that affect it. But really, climate is just so all-encompassing that it is something that we have to respond to. Secondly, it is something that we can do something about. So we can change the makeup of the portfolio to reduce the risk, but we can also invest in the transition. And there is a massive opportunity in investing in the transition to a low-carbon energy system.
I'd love to know how you think about this on a priority basis. Obviously, the super fund is there to make returns, to eventually contribute to the payments of NZ Super. So if it comes down to an investment decision that has a higher return but may not be as sustainable, or there's another option that is more sustainable but has a lower return, which one do you pick?
So yes, our job is to maximise return without undue risk, but that's over the long term. So it's very rare that you end up with as clean a comparison as the one that you give. I think it probably doesn't happen that much. So what you're really saying is, when we construct our portfolio, we're saying, well, we've got a core portfolio. If we're going to go and invest in something else, we're going to sell a bit of that, and we're going to buy this new thing. We want to make sure that new thing is going to generate more than what we're selling. So for us, if we can do that and we can have an impact as well, great. That's what we're trying to do. We're not here to give up returns for sustainability outcomes, but we're looking to find those opportunities which can do both.
What do you benchmark your returns against?
So we bench for each of those things that we introduce to the portfolio, we benchmark them against our expectations for whatever it is we're selling. So if we're buying, for example, an infrastructure asset, we'll sell some equities, some listed equities and some listed bonds. And so we'll have a view on what the forward-looking returns on those things are, and we'll add some illiquidity. So that's our benchmark. So we say we have to make the portfolio better off by doing this. So we do that based on what are the returns that we're giving up in order to invest in this thing.
Say I know nothing about the super fund's existing portfolio. What do you invest in if I didn't know?
So the biggest part of our portfolio is global equities, and we invest in those where we track an index, and the index that we track is the MSCI Paris Aligned Index. So that's an index that's chosen out of the listed companies in the world to be consistent with the objectives of the Paris Agreement. So, but that's a very broad index. It might be 1,200 companies in that, shares in 1,200 companies. So very, very diversified across countries, across sectors, across different types of business. And so that's the biggest piece. The next biggest piece in our portfolio is now unlisted assets. So we've got quite a lot of unlisted assets in the property space, infrastructure, private equity, direct investments, growth capital investments, farms, forests. So quite a decent size unlisted piece of the portfolio. And then we have some other things like listed bonds and smaller allocations to hedge funds and other bits and pieces, and a chunk of New Zealand equities. So about 5% of the portfolio is in New Zealand listed equities.
The unlisted stuff is a little bit more exciting. At least I think so. I don't know what you think about that. But what do you see as the biggest opportunity in there? I know you're into venture capital. Is there anything else in there that you're really excited about? Like
I mentioned before, there's great opportunity in that investing in the transition. So depending on who you're listening to this morning, we were listening to someone who was saying we're going to need, something like 200 trillion invested by 2050 in order to be able to meet the Paris Agreement objectives. So there's just an astonishing amount of money required to invest in a low carbon energy system. So for us, what has been most successful for us in the last few years has been our renewable energy development in the US. So alongside Infratil, we've been partners in a venture called Long Road that has been developing solar and wind farms in the US, been doing really, really well. So I think and the thing about that opportunity is that it's scale. There's lots of it. So oftentimes you'll find things that are really interesting, but they'll be this small and they're not going to make a difference to the outcome, whereas something like that as an opportunity is global. That's why we're looking at, for example, the Taranaki offshore wind. Big opportunity, solves a big issue for us as a country. What a great confluence that is. There's still a lot of capital flowing to things that are considered non-sustainable. A lot of money still flowing to the likes of oil companies. Those emitters and producers of emissions are not always putting money into the renewable space because they don't all think that it's financially feasible. Yeah. What do you make of that amount of money still in that segment of finance, and are you disappointed by it? Yeah, look, there's a massive opportunity cost with anything that's going into new fossil fuel production. Is investment that's not going into a renewable source, right? So, and that just creates embedded emissions for years to come because you're going to continue to produce out of that well or whatever it is, and those emissions will just continue on. And so from our perspective, we're looking for those opportunities to shift capital away from that, to direct capital away, and I think that's the big challenge for all of us is to make sure that not only investors are doing that, but companies are doing that as well. Because as I talked about in the speech, there can be an agency problem here where companies will go off and invest the supernormal profits of the oil price spike of the last couple of years in new production, and we just don't need that as a world. And I think that creates more risk because ultimately those assets we think are going to end up stranded. You're just not going to be able to extract value from them. How do you feel when you see money still flowing to things like fossil fuels? I mean, clearly you're trying to make a difference. Does it get on your nerves a little? I think it reinforces the challenge that there is there for all of us. Would I rather it were being directed elsewhere? Absolutely. I think that it just every time that it goes that way is a missed opportunity for the investment in the transition.
I want to talk about the super fund more broadly. Withdrawals are set to start in the year 2035 currently. It's not too far away,
No.
just over a decade. You've mentioned all of these big, exciting long-term infrastructure developments and renewables projects that you're investing in, but the second money needs to start coming out. How would that change the mindset and potentially the investments that the super fund make?
Yeah, it's a really interesting question, that one. It's been a bit of a theoretical question for us for a while, but as you say, we're getting closer. We're a dozen years away from that. When withdrawals start, the way the Treasury model works is that those withdrawals start relatively small in the first decade or so. By the 2050s, they become more material in terms of percentage of the fund. But even then, the forecast is for our fund to continue to grow. So our long-run expected returns are expected to be higher than those withdrawal levels. Now, there'll be fluctuations around like that there inevitably are. But it is going to change. It will change something, because suddenly we'll have an outflow from a liquidity perspective which we don't have today. How that changes our risk tolerance is an open question, and that will be something for future CEO to solve. But I think and the CIO. So, but for us, liquidity is really important, right? So, as an investor, making sure that you've got enough liquidity to be able to manage your investment strategies, and most critically, never be forced to sell something. That's one of the most fundamental risks for an investor. So inevitably, if you introduce a liquidity drain, which these things will be, then that will have to change something. We'll have to change something in the makeup of the portfolio. Maybe we need to get our exposure in a way which is less illiquid. Think about what those are. Maybe that prioritises some of those investments a little bit more, and we need to make sure that we're getting the best bang for our buck with the illiquidity, the unlisted stuff that we're putting in there.
The super fund, correct me if I'm wrong, is supposed to hit its peak in 2070?
That's a peak as a percentage of GDP. So it's a relative measure, but it's still actually meant to continue to grow in nominal terms through the end of the century and just keep going, because it should still be earning returns higher than those withdrawals. So it's a peak as a percentage of GDP.
I'll be retired then. I'll be 75. I'm not going to get you to do the maths on that to figure out my age, but someone like me will be relying on it at that stage. So tell me what you think the super fund should look like in 2070. You may not be here. It may not be your problem, Matt.
I definitely won't be here. It would be a stunning turn of events if I was here. No, look, what will it look like? Well, it will be large, and it'll be big as relative to the size of our economy. It will be contributing at that point about 20% of the cost of national superannuation to the country at that stage. So the outflows at that point, plus the withdrawals at that point, plus the tax that we pay will fund about 20% of that. So it'll be an important contributor to your retirement personally. What will it look like? It will still have to have a lot of listed securities in it, I imagine, because it's going to need to have liquidity. It will be run in a completely different way, I imagine. Who knows? Maybe it will be run completely by AI at that point, and you won't have anybody there. We used to laugh that the idea was to have two people and a dog, and the dog was there to bite someone if they tried to touch the controls. So maybe you just need an AI to run it. Who knows?
The super fund is our biggest institutional investor, has more assets under management than the ACC. What do you want people to know about the super fund that they may not know?
So what do we want you to know? We're not far away from the ACC. We're pretty similar in size to those guys. Look, we're a long horizon investor. We care about what the value of these markets, these economies, these companies are over the very long term. And that means we've got a lot of considerations to incorporate in our investment decisions. We're a very broadly diversified investor. We've got exposure to companies and economies and markets all around the world, and we've been very successful. So to date, the country is more than $40 billion better off as a result of the existence of the Guardians of the super fund, and that's something that we're very proud of.
The tax take's looking a little bit better thanks to the super fund too. You've paid at least 10 billion in tax since inception?
Yeah.
Make that make sense to me. Why does the super fund have to pay tax when charities don't?
Yeah, I don't think it makes sense. Michael Cullen's tax working group didn't think it made sense and recommended that we don't pay tax. There's no change to the government accounts as a result of us paying tax. If I take my wallet out of this pocket and I stick it in this pocket, I haven't got richer. If that would work, I could just keep doing it, or if that actually made a difference. So I would just increase the tax rate on the super fund and then we'd all be richer. So it doesn't make a difference. It makes a difference at the margin from a cash flow perspective, but what it does actually for us is it means that we have to incur costs to manage that tax. We end up paying tax in overseas jurisdictions where we turn up to the overseas jurisdiction, we say, oh, we'd like sovereign immunity and because we're part of the Crown, and they go, well, that's weird, because do you pay tax at home? And we go, yes. And I was like, well, you can pay tax here. So, it just causes dead weight loss. We don't think it is sensible, and we'd like that to change, but, it's pretty hard to get people's heads around that because they think we're trying to take something away from them, and we're not.
But imagine the compound interest that you could have made if you reinvested those tax payments. If you didn't have to pay tax on those dividends and you could put it back into investments, it'd be enormous. It'd be hundreds of millions of dollars.
It would be a lot. But one of the things is if we are, the way the formula works, if the contributions are being made, then the tax becomes a little bit of a wash. It's tied up in the way the formula works that Treasury runs its model on. The biggest issue is when contributions are stopped and we continue to pay tax. That's when you're actually just sucking money out of the fund, and that becomes the problem.
If you had a departing wish, would it be to be tax exempt and also to have consistent contributions? What would it be?
Look, I think, contributions according to the Act, fantastic. I think that, it was created, it's a really smart piece of legislation. I think the people who designed it, Sir Michael Cullen and others, and the people at Treasury who did it, fantastic. They created great structure, good independence, a good model for it, and it's really a matter of just sort of letting it work as intended. And so, but my wish would be that we didn't pay tax, because I think that would just solve a few issues for us. That'd be nice.
You are going?
Yeah.
What's next for you, Matt?
Hopefully summer, hopefully we get a summer this year. That'd be nice. So then for me, it's about taking some time at that point to think about what's next. And I can't really do that while I'm still in this and working through to the end of this year in order to be able to hand it over to someone to step into that role.
Former super fund heads have then gone on to be Reserve Bank governors. Is something political, economic in your future, do you think?
One has gone on to be a Reserve Bank governor, but he came from the Reserve Bank in the first place. So
that's true. He only went back, didn't he?
Yeah. I just don't know at the moment. I'm really looking for having some time, having some space to think about that and see what might come as a result.
Who's going to be your replacement?
Well, that's up to the board. So the board's in process on that now. So they've appointed a recruiting firm and they're underway. So, hopefully we'll see some update on that in the next few months.
Well, I'm sure this won't be the last time we chat, but it may be the last time while you've been the head of the super fund, and you have always been a gem and a bloody funny person to deal with. So I appreciate your humour and I appreciate you taking the time today.
Thanks, Madison. No trouble.
When I caught up with the fund's Chief Investment Officer, Stephen Gilmore, recently, I did ask if he was putting his hat in the ring for the exec role, but he didn't give much away. So I'll let you know when Whineray's successor is announced, and hopefully they'll be up for an interview too. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald's show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.